So I was waiting to put this document out until after you read the paper. Maybe we can get some lights out. Is that okay? Can you see, Ricardo? You're kind of in the dark, and Jennifer. Can y'all see all right? All right, so I'll put this out there. The key here is that it gives you the rubric. And so we'll walk through the rubric, especially when he gave those three things that he learned. There's a trick to it that some students really get too focused on only summarizing the article and not summarizing, including the discussion in class. And there's one area in particular where students lose a lot of points. And so I want to make sure we don't have that issue. So we'll go through here. So what is float is what you start with, because that's what he's talking about. What is float? So don't mix up the cost of float with float. Don't mix up the investment earnings on float with float. Float is a liability. You know, it's a reserve. It's money that you have that you don't really own because you're going to have to pay it out. We said it's kind of like debt, kind of quasi debt. You know, all those things we talked about. The cost of float, that's where you want to make sure you talk about the combined ratio, which he doesn't talk about in the article. All right, so there's a really good example of something that we talked about in class that's not in the article at all. So combined ratio, y'all remember that, your outflow over the inflow. If it's above 1, you're spending more than you're taking in. If it's below 1, then you have a profit. And I told you the combined ratio for auto insurance is usually about 0.95. But then the Economist had an article I might show y'all. I was talking about how auto insurance is not making as much money as it used to. I don't know if y'all have noticed your auto insurance rates shooting up here recently. So I might show you that article. But generally, you think auto insurance has a combined ratio about 0.95, which, remember Buffett, what he's saying is it's like they're borrowing money at a negative interest rate, which is great, negative 5%. You take in 100, you only have to pay back 95. That's a pretty good business. And then he gets into controlling the cost of float. So if you remember in his article, he said, is these three things, the bottom of page 7, but I said, I've got more than those three things. Okay, so let me show you what I have. Let's look at the big picture, and then we'll get into it in more detail. So I have 6 things here. The first one is expected profit. It's important in your paper. We talked about it last class. I don't mean you make a profit every single year. That's really not possible for reinsurer. But over the life of a product, even with bad years, you should make money on the product. So reinsurance is usually really high earnings and then one really bad year and then high earnings. That one bad year shouldn't wipe out everything else. You should have a good profit. Be willing to walk away from unprofitable business. So if you're unprofitable, we're willing to lose market share. What was the word he used? Anybody remember? He uses the word blithe and sanguine. Here he uses sanguine. Is sanguine means what? You don't just walk away from business, but you're really happy to do it, which I don't think he thinks that. I forget what blithe means. He uses that somewhere else. The next one we talked about was ability to evaluate. He doesn't use the words frequency and severity in his answer, but I want you to that in your answer. That's what we mean in property and casualty. We talk about probabilities. We mean frequency and severity. So auto insurance, what anybody remember? Frequency is what? Number of accidents, and then severity, the average claim. All right. Now life insurance is different. Life insurance is not the number of deaths because most people only die once. It's your probability of dying. And then the severity is stated in the contract. If you die, you get $200,000. So, but on auto insurance, homeowners insurance, it's the number of claims and the average size of the claim. So make sure you discuss that. And then he also talked about avoiding remote loss possibilities. And here, what he's talking about is multiple losses all getting together because of some unintended correlation. Things that you thought were unrelated suddenly become related. When do things that aren't usually related suddenly become related? in the extreme, in the tail. That's when things just kind of unravel. If you're in my risk, a few of y'all are in my risk management class, Doug Hubbard talks about the domino effect. Normally these things aren't related, but you go to the extreme, suddenly things that you never thought would be related are suddenly related because everything's just falling apart. So on number 3, make sure you talk about frequency and severity. On number 4, and make sure you talk about correlations. Very, very important. 5, I said, was a real simple one. He said, avoid business with, unethical people. That one's a gimme. You just say that and you got the points. I'm not asking for a discussion there. It's just this third one. So that one's easy. So where do students lose most of their points? It's on this last one. All right. So we'll get into that. There's 2 parts to it that you've got to get, and it's the second part that students really. So I want this class to do well on this because I've had students just like such easy points and they don't do it at all. So everybody highlight really heavily. This is 20% of the paper, and he spends a lot of time in it. But the interesting thing here is it's not in his list of 3. He discusses it later in another section. All right. And then the last one is that I say page 10. Is it page 10? Boy, I guess it is. The top of page 10. Yeah. Yeah. So that discussion is the last thing that you do. Okay. And then I say other related research here and critical thinking. So here 10% is Google something, Google Warren Buffett and float, and find something more recent that he said. And there's plenty of stuff, find an article about that. Look up something on experience versus exposure, find something. I'm not saying it's not a research paper. Find some article, gives you some insight of what he's saying. Maybe it's a little more current than what's going on here. Okay. So don't forget that one's there. It's not a research paper, but you could probably get away with one really short article and some insight to what he's saying. You saw last class, if you type Warren Buffett in float, a lot of things come up, and try to find something published maybe in the last year or 2. What a lot of students did last time, they say, what he talked about from 2001 is still current today. I found an article from February 2023 where they said this. Very consistent, it can be consistent what we said in class. Even more exciting to me is I found this article that disagrees with Buffett and made this argument, something along those lines. All right. So I'll put this out on Canvas so you can see. Pretty straightforward though, isn't it? 10 things and each 10%. So some of them are really easy and some of them got to make sure you're ready for. All right. Okay, so let's look back at his list of 3 that I make 6. So last time we talked about ability to evaluate. That's the frequency and severity. You have to include remote loss scenarios. Even after those, over time, remember, over time is really important. Over time, you still expect a profit. We'll talk about this on homeowners. A good example is earthquake. When the earthquake hit California, the North Ridge, we had not had major earthquakes at all. And in that one year, that one earthquake, companies were losing every premium they've ever collected in earthquake all in one year. They didn't lose all their profits. They lost all their revenue for all the time with that one event. They obviously have been mispricing earthquake insurance. So guess what they did with earthquake insurance premiums? They weren't going up 30%. They're going up 300, 400, 500%. It's just, that would be an example where they did not do their math. They weren't looking at it carefully. And in one event, they lost several years of income. So he's saying you got to look at those tail events, those extreme events. And even if they happen, yeah, you'll lose money in that one year, but over the 10-year period or whatever, you still have a profit. Here's the sanguine. If the market starts mispricing because they're trying to get market share, you say, hey, go for it. You'll all go out of business and we'll pick up the pieces after you're gone. That's that kind of attitude. I don't really think he's sanguine about it, but that's his attitude. And then the aggregation, this last sentence that I love so much, ceaselessly search for possible correlation among seemingly unrelated events. I would put in your answers things that are seemingly unrelated that become related this is real important to our risk management class too. Those taking that is it's in the tail in those extreme cases. So I would try to bring that into your answer because I do think that's really, really critical. Now, in his case, maybe it wasn't singly unrelated because he was saying, remember on the Twin Towers, well, I've got multiple employers, so I'm diversified, but no one ever stopped to say they're all in the same two buildings. So even though those buildings have been attacked just a few years before that, like 6 years before that. All right. So there's the first five. Any questions on the first five before we get into this tough one? Can y'all handle those? I'd probably write the first five this weekend or this week and get them out of the way. And then if you've never had me before, come by office hours. I won't rewrite it for you, but I'll say you're going to lose a lot of points on that one. And that might be insightful to you, wouldn't it? But no, it's like, you're not going to get many points on that one. All right. No questions, comments? All right. So this is actually my favorite part of the paper. So here he's going to talk about something called experience, something called exposure. Experience is pretty simple. Experience is historical frequency and severity. That's all experience is. It's a historical statistics. Is experience useful in insurance? Absolutely. Yeah, you want to know how many auto accidents 22-year-old male drivers have had driving, 6-cylinder red sports cars. You want to know how many married 42-year-old men have accidents driving minivans. That's the kind of thing you want to know. Do we have data for that? Yeah, we have plenty of data of that. So for auto insurance, it works pretty well. But what if, now when I graduated from high school, y'all know what the maximum speed limit in the United States was in 1980? 60. Well, 55, right? It got down to 55 miles. Can y'all imagine 55 miles an hour? What was that? Jimmy Carter, the energy crisis. Ask your grandparents, they might know about it. Your parents would probably, no, they may not. So 55. So what happened when we went from 55 to what's the max speed limit in Texas today? Don't we have an 85 somewhere? Do we have an 85 or is 80 the max?
Definitely 85.
I know there's an 85 somewhere in the country. So 85. What happens to frequency and severity when you go from 55 mile max to 85 max? So what do actuaries do? Can you rely on experience? Well, obviously not. Something has changed. But most of the time, experience works really well. For life insurance, experience works extremely well. But then something like COVID hits. Or in life insurance, they're dealing a lot with drug abuse and I don't even know these drugs. Fentanyl, whatever. I don't know any of these things. But there's been a high increase in drug overdoses in the United States. It's still not so massive that it's as big of an issue as hurricanes and earthquakes are to property casualty, but it is something life actuaries have to think about. So experience looks really, really well, but when doesn't it? So what is exposure? The exposure is what you're insuring, what you're telling people you're going to cover. And what Warren Buffett is saying is you can't just look at experience and ignore exposure, because experience can come up and bite you because things can change in the future. So we had looked to the past and taken into account only costs we might expect to incur from wind, fire, explosion, earthquake. What's missing from that list that he was worried about in 2001? Terrorist risk. In 2001, you're looking at the historical terrorism risk, and what do you see? Not a whole lot in the United States. You had the Oklahoma City, which is a horrible event, right? Very, very tragic event. I forget how many lives were lost there, a building, but pretty minor relative to 9/11, but massive at the time. It was a huge event. That was about the only one. Since then, we've had a few in the United States, but you've had some overseas as well. So no experience. So what do you do when there's no experience? What will be the largest property loss in history? We had none of those forces. All of us in the industry made a fundamental mistake of focusing on experience. So you might put that in your paper. The industry mate, isn't that a great sentence? Doesn't it tell you Experience, so experience isn't bad, it's great, but it has a flaw. If you over rely on it and don't consider exposure, you can, essentially go out of business is his biggest concern. So how much premium did they receive for terrorism coverage? Assumed a large risk and receive no compensation for that. What's the chances of having a profit over 10 years if your premium is zero? It's not going to be too good. So he says, just like I said, experience, of course, is highly useful starting point. And y'all remember underwriting. Well, I don't know if we talked about underwriting. We'll talk about a little bit more on Wednesday. But underwriting is when you sit down and you assess what the risk is and what you're going to charge for it. Is this a risky person or is this a low risky person? Is this a risky driver or a safe driver? That's what underwriting is. So experience is a good starting point. So who drives better, a 23-year-old female driver or 23-year-old male driver? Who's the better driver? Female drivers, by far. We'll see later. There was actually a campaign, was it in England? They went out to high school boys and said, drive like a girl. And I'm not sure how effective that campaign was, but what were they saying? Boys are horrible drivers. They do stupid things. So how much is the difference? It's fairly significant. If any of y'all have teenagers when he's done, you're going to know the difference between a teenage boy and a teenage girl. How reliable is that? It's been really consistent over time. And so insurance companies, obviously, you're going to price off of that. Who's a better driver, a 40-year-old single man or a 40-year-old married man? Married man's a better driver. Why? I saw that with my brother. I'm going to tell you this story again, but I remember in high school, I wouldn't ride with him. He was crazy driver. And then 20 years later, married, 2 kids, I'd ride with him. It's like, Art, can you speed up a little? It's kind of, why are you driving so slow? But he was like completely different person because he had a family or just because he got older. That's very reliable stuff. We'll see that when we talk about credit scores. We'll see all those factors insurance companies look at for homeowners and auto insurance. How many accidents you've had, how many speeding tickets you have, those kind of things. Those are pretty reliable, very reliable. So using experience as a guide to pricing, there's times where that's not only useless, but actually is dangerous. But when is it? With auto insurance, no. You're going to rely heavily on experience with auto insurance. So he gives some examples. So this is real key. Look at the rubric here. This is where students really have troubles. See this thing right after number 6? Examples. All right, so I'm actually going to go into it before we cover the rubric. So I'm going to cover this and I'm going to go back to the article because he doesn't do this well. He hints at it. And I think that's why a lot of students miss it in the paper. So there's 2 ways experience can really cause you problems. And you need to give those 2 ways and talk about them. He gives a few examples here. One is you have very limited historical experience. It just doesn't happen much. The best example is there, and I love it if you think of another one. Terrorism, which is what he's talking about, terrorism risk, hadn't been that many events. And then the other one I mentioned with Northridge, earthquake. There just had not been that many major earthquakes. So not much experience. That doesn't mean risk isn't there. It just means it hasn't happened yet. So limited data. Can y'all think of a third one or a fourth one?
The earthquake is not like the same as the terrorism example.
Yeah, earthquake's very similar because,
right.
Well, I'm talking about at the point of Northridge. At the point of Northridge, we had very little history.
Okay.
And we knew California was exposed, but we just had not seen one for so very, very long. I mean, you have to kind of get creative. It's hard to think what risk you might cover. Well, y'all tell me where this belongs. So 1980, what was your experience with cyber risk? Non-existent. All right. Have we had some major cyber events recently? We've had some. Do insurance companies cover cyber risk? And that's been a big debate. Can they cover cyber risk? And they do have some coverage, but it's a very, very dangerous risk for them to cover. Do y'all think this risk is getting bigger? And if it's getting larger, is it getting larger exponentially or linearly? Yeah, it's just a scary. Any of y'all cyber majors, cyber risk, that's school. Y'all here, we're losing our cyber risk students to another school. They're going to start a new artificial intelligence school. So we're going to lose that group. Major risks. Does that fall under limited historical experience or the second one? I could see it fitting in both. So let's see what the second one is. So the first one, you don't have much history on frequency and severity. The second one is you have plenty of history, but the distribution is changing. So the frequency and severity are different today than they were historically. So good examples, almost obvious example there is global warming. What is the fact that things are getting hotter, especially water? We'll talk about hurricanes. Water temperature is extremely important for hurricanes. If water temperatures are getting higher, that's going to give us stronger hurricanes. That means all that history is not going to be of value to us. So that's the debate. Those two go together. Changing laws, changing equipment. So on the auto side, when SUVs came out, insurance companies' initial thought was, well, this is great. Our customers have these SUVs, they're almost indestructible. You drive around with a Humvee, and then it's like, hit me. What are you're just going to bounce off. And then suddenly they discovered, yeah, that's true. Our property damage has gone down. But what happens when your customer owning the Humvee hits a VW? The severity of the liability risk shoots up. So they had less property damage, but they had much higher liability loss because their customers were causing much more damage. So they had to say, okay, we got to look at that differently. So in his case, he's talking terrorism risk, and that was his focus. He gives another risk, which is D&O. Y'all know what D&O stands for? Does he say what it is in the paper?
No, he says it, but he doesn't. He just says consequently the correct rate for D&O.
Anybody know? Have a guess?
Directors and officers.
Directors and officers. So what is directors and officers? So that's when stockholders sue companies because they think management made a mistake. So let's say you're in I don't know what year, let's see here, 1998, 99. You've had a bull market for the last decade or two. How many people are suing management for losses in the stock market? Not very many, right? And then you have this massive market sell-off in 2000. Guess what people are suddenly doing? They're suddenly suing management. So the distribution changed. Why? Because people sue more during bear markets than do in bull markets. So if you've had a long bull market, D&O looks really safe. But that actually may be when it's the most dangerous. Why? Because stock markets may be overpriced. They're due for a major sell-off. So D&O is an example of this one. Think of others. What about this? Are electric vehicles going to be different? So what do we know about electric vehicles? Lower frequency, we hope. But what about severity? Maybe higher? Who knows? I don't know the question answering that. Why is frequency lower? Well, because there's less mechanical parts to replace. I don't know. I may be. Let me change this. I'm gonna go AVs first. Ignore what I just said on EVs. We'll come back to it. AVs. So what are AVs? Autonomous vehicles. Have any of y'all ridden in an autonomous vehicle? I mean, other than a plane? I haven't tried it. Like, is it San Francisco that has AV taxi service? So none of y'all try. Would y'all try it if a car showed up and no one's in the driver's seat, would y'all get in? You say no? All right, so here's where you have lower frequency and higher severity. So you have lower frequency because machines are better drivers than humans, but you have higher severity. Why? Because you have cameras all over the place. You got all this extra equipment. I don't know what I just did. I typed something. I love it when I hit a key I didn't know I was hitting. I don't even know what I was typing. The advantage of the frequency side is AI, which I love. I think that's great. So if an AV makes a mistake, suddenly every single AV in the world learns that mistake because they all teach each other. That's a wonderful thing. But if you do have a crash, it's going to be much, much more expensive because you're replacing all this extra equipment. But one thing on frequency I would ask that I just mentioned before, what about cyber risk? Could someone tap into these cars and have them all crash at the same time? That would be pretty interesting. So I don't know how the insurance industry is going to handle AVs. We'll talk more about AVs later because the other issue might be if we have autonomous vehicles, it may be cheaper for you not to buy a car and just use your iPhone and order a car whenever you need one. That'd be kind of cool, right? You don't need a garage, you don't need a car. In that case, if there's an accident, who's responsible? You don't own the car, so you don't care. You just get out of the car and order another one and just leave it on the side of the road. So we don't know who's going to be responsible. It could put USA out of business because you're not buying cars anymore. You don't have auto insurance anymore. So AVs, it's interesting. EVs, I don't know if frequency has a impact, but severity, you're talking about auto replacement parts. But I'm pretty sure if you Googled auto insurance and electronic vehicles versus gas engines, there's been articles written about it. There's a sense that EVs are more expensive than gas cars. Just from that standpoint, severity will be higher. But there are fewer moving parts. They don't have carburetors. You know, carburetors are pretty expensive, right? There's a lot of carburetor theft going on around. You know, so that's one less frequency. So these are all things that some of these belong under this first one, right? AVs belong under here. EVs belong under there. Some of these belong in the second one, but that's what you're looking for. When can experience lead you astray? It's obviously very, very valuable, but if you don't have much history or there's some sense that the world is changing, those are two areas where you got to be really, really careful. He doesn't make that distinction in his article. He just gives examples. You just have to kind of read between the lines. So late in the bull market, D&O, oh, there it is. He put it below, yeah. He didn't use the ampersand, but so are likely to be relatively rare when stocks are rising, no one to sue. In fact, you know, these lawyers that are out there, lawyers that do D&O type of claims, they're just, anytime a stock drops 10, 20, 30%, they're just going to sue. And then they'll have discovery. They may find a bad decision. They may not, but they don't really care. Just sue and then, you know, figure it out later. Maybe you don't have a good case, or maybe they'll just settle. I had D&O during my career. I always thought it's funny on board meetings. You kind of have the board meetings, you know, some of the board members kind of bored and they're, you know, pun intended, they're kind of not paying attention. And then the D&O insurance guy comes in and suddenly they're all interested. Like, how much coverage do I have? What happens? I never thought it was enough. I got $25 million of coverage and I was running $6 billion in pension and 401k plans. Any of those employees could sue me for any decision I made on their pension or 401k. And I got $25 million in coverage. And I was like, could you pump that up to like $6 million, please? But yeah, I can get sued. you that are finance and actuary majors, you can be sued personally if you make a bad decision. Your firm provides you some insurance, but how much? Is 25 million enough? You know, that's the question you got to ask. But you are more exposed to sometimes more than others. That's just when exposure is likely to be exploding during a bull market. Why? Because things are overpriced. There's a lot of risk. When stocks fall, everything is exposed, and that's when you start having bad losses. Insurers always found it costly to ignore new exposures. Doing that in the case of terrorism could literally bankrupt the industry. No one knows the probability of nuclear detonation in a major metropolis this year. So we got this guy in North Korea who's essentially saying he's at war. That's always good, right? You got a guy who has nuclear bombs saying he's at war with South Korea. Is he doing that because he's serious, or is he just hasn't been in the headlines in a while and he's kind of get back in the headlines? But it's kind of scary. He's testing these long-range missiles. What city would he try to hit in the U.S., do you think, first?
Well, it can reach
What would he be closest to? He's probably closest to California, right? You would think.
Mm-hmm.
Could he hit Hawaii, maybe? You know, so what would he hit? He'd be done for if he did it, but you know, we're talking about someone who just got diagnosed with some terminal illness. That may be his swan song. Who knows? So these are things we don't really know. Usually insurance doesn't cover war risk. So if it's a war related event, you know, that's not covered. But you know, that's the kind of thing you're asking a terrorist organization with a nuclear bomb. I don't know if that's really possible or not. I'm not really sure who might have access to a nuclear weapon, but who knows? We don't really know, right? So a biological event, you would probably think New York City, because that's the most densely populated city for that type of event. How much damage could they do? What could they actually do? Multiple office buildings, all that kind of thing. So he's asking these questions. And then he says something I don't agree with. Y'all see if y'all agree with it. He says, this is what we do know. See if we actually know these things. The probability of such mind-boggling disasters is not zero. I would agree with them on that. I mean, what is probability? A probability is not an actual probability. It's a reflection of our ignorance. It's what we, you know, I don't know how you put a probability on something like this anymore, but it's not zero because there's no way we can know. This is the part I'm not sure about. The probabilities are increasing. Is that true?
Yes.
Probably so. I don't know if we know for a fact, but the probability of some terrorist group getting a nuclear bomb, I guess the probabilities are increasing just because of the passage of time. Over time, people are trying and trying. Eventually, someone may figure that out. So he also says it's irregular and immeasurable. What do you think he means by irregular? It's just like a jump in knowledge.
We may not be able to predict it, and the driving force behind someone wanting to do it, we don't know what that lasts.
Someone initiates it. Mm-hmm. Yeah, that's true. We have a lot of conflicts in the world right now. You might have made someone really mad that suddenly has a reason to do that.
For about 3-4 years ago, I had to go through this special training, and part of the training was the class was about 25 or 30 people, but we had to go into this room and then we had to come up with ways on how we could do those type things. And yeah, but we were just doing it.
Yeah, one thing I did at UTSA, which sounds crazy, but I thought it was really good, is I sat down and I figured out how could I destroy this company. Mm-hmm. And I could figure out I could do it. That gave me the power to do it. And my thought is one person should be able to destroy UTSA. So I went out and created policies so I couldn't do those things. And then I told the CFO that I had done that. I didn't tell him before. I told him, you know, y'all gave me these powers and you shouldn't have done that. It was really crazy what they did, but they said, well, it's Ron. He won't do anything. Well, you don't know. You know, I'll break up with the girlfriend and it's like, okay, I'm taking everybody with me. Who knows? You know, that's stupid. Just rely on some person because, you know, that's kind of that experience they're relying on my experience because I haven't done anything stupid yet, but I'm capable. So yeah, you never know. That's the irregular. It's just all of a sudden some guy just goes crazy because he's upset with something. And then the other side is irregular and measurable, but we may actually becoming more complacent. The risk may be at its greatest when we're most complacent because someone's been secretly doing this over time. It's kind of, not to bring up controversial issues, but Hamas attacking their attack, that was, it was amazing. Israel wasn't aware of that or wasn't expecting that. I think their military probably got a lot of bad marks for not expect. I think Hamas might even be surprised that it worked as well as it did. But again, it's this kind of thing where we kind of get complacent and don't watch it. I'm kind of amazed 9/11 happened because there seems to be so many clues that there were people taking flying lessons, but they didn't seem to care about how to land a plane. That's pretty serious, indication there's something strange going on here. And we rely heavily on our government and their intelligence to be doing this for us. We're paying billions of dollars to do this. I think George W. Bush was really interesting in his second term that he said he was really worried about a pandemic. He set up the entire pandemic task force. He said, we got to be prepared, really intelligent stuff. But then nothing happened for 10 years. And so all that was shut down. And then when the pandemic hit, we lost all that. So you can't just be diligent for 8 years. You got to be diligent for, forever and ever and ever. So terrorism, what he's talking about. So the problem is time. Over time, we'll get more complacent. And over time, the enemies are just gonna they can wait 10 years, 20 years, so it's kind of scary. So I don't know how he knows the probabilities are increasing other than just probably just the exposure of time. All right, here's the word blithely that I don't remember what that means either. Anybody know the word blithe? So I have to remember this semester so I can remember these words. Sanguine means happy. Blithe, that's a definition. Indifference. All right, so I got to get this. Blithely, you don't care. You're just indifferent. Sanguine, you're happy about it. All right. Use these words this week in a conversation, unsuspecting conversation, and see if they know what you're talking about. Cheerful. Well, it is a little bit, but it's cheerful indifference. I'm not sure exactly the difference between indifference and cheerful indifference, but casual makes more sense to me. Callous. So what is he saying here? Insurers and reinsurers have blithely, I think, just without really paying attention. I don't think they're happily taking these consequences. I think they're just being a little too casual. They've blithely assumed the financial consequences from the incalculable risks of terrorism. All right, so under the close to worst case scenario, he says could involve $1 trillion. Who knows? I forget how much 9/11 was, but it was a very, very large event. Only the U.S. government could handle that. And the industry itself would probably go insolvent. Now, the U.S. government can handle it because they can print money. The U.S. government doesn't handle anything. Taxpayers handle it, so eventually it comes back to us. But only U.S. government could actually step in. So who's the only person who insures flood risk? Well, the U.S. government. Insurance companies don't insure flood. Why? Because it's such a massive event. And there are people who think terrorism should be one of those events, not insured by the industry, but only insured by the U.S. government. So there are some risks that are so massive they could destroy the entire industry. And the question is, can the industry actually insure those events? And he says close to worst case, mainly because I think, the worst case, every worst case wasn't the worst case until it happened. And so the next one's going to be worse. So there's always a worst case out there. I don't think we've ever had anything anywhere close to $1 trillion. I don't know what the largest, I keep forgetting I'm in. Largest catastrophe financial loss in history. Katrina. Yeah, you have to, okay, so we'll see when we do catastrophe risk. You have to distinguish between largest loss and largest insurable loss. Um, you also have to distinguish between, you're talking about United States or in the world. I actually think Indonesia was probably the largest loss in terms of human loss. I don't know if you remember that tsunami, and hundreds of thousands, really, really tragic loss. And Indonesia is nothing but islands. I forget how many islands there are. It's just an amazing country, just thousands of islands. So a tsunami, huge impact. So are you talking in dollars? Are you talking human life? I think the largest human life in the United States is still Galveston Island. I think that was a few thousand people. So the United States does not have a major loss as far as hundreds of thousands, a few thousand. And that was, over a century ago. So there's different ways of defining it. Here's the World Atlas. Maybe they will tell us. Yeah, Japan was a big one, no question. 300 billion. How much of that was insured? I don't know. It is a tsunami. So you think in the United States, a tsunami is not covered by insurance because that's flood. We'll talk about that later when we talk about storm surge. So earthquakes, hurricanes are covered, but hurricanes are only covered for the wind. The hurricane causes a major wave to come in, the wave's not covered. So we'll talk about this later. So the adjuster, remember the adjuster? They show up. There's nothing but slabs, concrete slabs. And they have to figure out what percentage was damaged by the wind and what percentage was damaged by the flood. And what do they want to say? Oh, it's 90% flood, 10% wind. Why? Because they only pay for the 10%. So here there's a huge difference between insurable risk and total losses. The death toll is not that much. I can't recall Indonesia. I don't know how to spell tsunami. So 2008, they show how many people? I remember it was over 100,000. So it's not gonna let me show the page. So so he's saying we're talking about something over 3 times the size of Japan's tsunami, which is not high human death toll, but very high dollar cost. Why wasn't Indonesia a high dollar cost? Because it's a poor country and it's a lot of people on the coast and kind of inexpensive place shacks. So, that makes a big difference. All right. So when he talks about experience versus exposure, he's talking about something that's extremely, extremely low frequency. And we probably have never seen it, but it could wipe out the entire industry. So that's that first example he's given us. Not much experience, but when it happens, it could be really horrendous. Now, is it possible that something that he's talking about here fits in both categories? So very limited history, but it's also changing. And that's where I think terrorism kind of could fit in both. It could be limited experience and huge changes versus history. It could be both. So we'll see that terrorism follows a power log. So by a power log, what it means is the high frequency things have very, very low losses. But then there's this extreme event, and it's not, it happens 1% less frequently, but it's not 100 times more costly. It's 1,000,000 times more costly. So the costs go up. I may show you the chart on the power log. So there's this huge correlation between frequency and severity, and it's not linear, it's exponential. So as frequency gets much, much lower, the severity shoots way higher. Do y'all know that on earthquakes? The different Richter scales, that there's a massive difference between a 5 and an 8 or a 9. It's not linear, it's massive. And so that's the kind of things he's talking, very, very, very low frequency, but the severity can be massive. All right. Questions on that? You'll see what I'm getting at there, and it's not, you see that it's not in his, it's not in here at all. I mean, it's in here, but it's not as clearly stated as I stated. So make sure you should have a sentence in your paper, specifically the 2 ways experience can lead you astray are, and make sure you have those. I have probably a fourth of the class that gets 0 points on that part of the paper, which is really, really bad. And those students, I'm pretty sure, wrote their paper and relying entirely on the article and not looking at class notes and not looking at the rubric. So maybe I've caused some of the problem here. So that's essentially 20%. You got to explain experience. You got to explain exposure. Some students really struggle with how to discuss exposure. He doesn't define it well. To me, exposure is essentially, what are you insuring? What are you promising to do? That's what exposure is. That's what Warren Buffett says is important. If you're saying you're going to pay workers' comp for anyone who dies in an event, that's your exposure. The fact that nothing like that's happened in the last 50 years, that's your experience. That has nothing to do with your exposure. He's not necessarily saying, like a life insurance, your exposure is, what if every single customer at Prudential all died at the same time on a life insurance policy? Well, I'm not worried about that, because if that happens, we're all dead. If every customer at Prudential dies at the same time, we're all dead. So they don't have to worry about that because no one's in business anymore. So it's not quite that extreme. But what if Prudential saw 3 times, 4 times more people die than expected? Could that kind of event happen? This is really more a property and casualty event than a life insurance side. It's hard on life insurance to have that kind of extreme event, but on the property and casualty, you really, really can have that kind of event. Right. Before we get to page 10 assessment, how do y'all feel? Which of these are you a 10 on? Anybody 10 on any of these? Some of them are fairly straightforward. What about avoid business immoral people? Any 10s on that one? Y'all got that one? Okay. Expected profit, multi-year, remember that? Sanguine about losing market share, you a 10 on that one? That one's a fairly straightforward one. Make sure you get frequency severity in there. Make sure you have correlation on that one. So y'all should be getting pretty close to 10 on these. That's why you should write them up immediately now that you're thinking about it. I think the other problem students have is we finish talking about this and then they do the paper 3 weeks from now and they haven't looked at it since, and then all this just goes away. So I would write the paper right now because you don't really have anything else to do in the class right now. So I don't know where you are on 6 and 6B, I guess. Anybody 10 on those? A 7, 8, getting there. All right. All right, let's talk about the page 10 assessments. So think about everything he said in those 6 things. And then we get to page 10. So what I would, if on page 10, the way I would handle this is some of the words he uses that I think are really, really interesting. Let's start with this. Particularly busy. He just gave us 5 pages on that we need to be more cautious. We got to be more careful about risk we take. Oh, but Ajit, man, he's been just really productive, particularly busy. Does that sound consistent with let's be measured and careful? Let's see the other word he uses. Yeah, I like this. What do you think about this sentence? No one can match the speed with which Ajit can offer huge policies. Does that make sense with what he's already said? Now, this Ajit guy is a pretty important person. Mm-hmm. He's been mentioned as a Warren Buffett replacement. I don't know if he still is today, but he's made a good name for himself. Obviously, he's the head person for the insurance side, which is a big part of this business. So an important person, but that sentence always strikes me as a little out of character for the rest of this paper.
Maybe he's just kind of throwing that in there to, because he's saying all these other things and he wants everybody to still be okay or feel okay. Maybe it's warm and fuzzy.
And he says that here, right? We will not. So In all cases, we have attempted to avoid writing groups of policies that might aggregate. So he's getting to that, this part of the rubric, avoid remote loss possibilities that can aggregate. So he says we're avoiding that. Let's see if he's actually doing that. So I asked that question. We will not write coverages on a large number of office and apartment towers in a single metropolis. So that was his problem with the Twin Towers. So I always worry about this with risk management is, that risk that just happened, we're not going to let that happen again. Is that good risk management? That's what the rating agencies do. Rating agencies are wonderful about managing the most recent risk. They're not really good at seeing the next one coming. So, all right, so let's look at what he's doing. He's going to do $578 million of refinery losses. So would a terrorist group want to go and bomb a refinery in the Gulf of Mexico? What would that do to oil prices? One refinery, or if that's, maybe I'm thinking that maybe that's not a refinery. Maybe he does have platforms here. So refinery, blow up a refinery. I don't know how many refineries Valero has. Quite a few of them, though. You blow up one of them, what kind of impact would that have? What about terrorism for international airlines? Several. Now, this seems really morbid, but it's kind of me trying to destroy USAA. So you're in a mind of someone who wants to do damage and get headlines. And you just read Warren Buffett's page 10. What's now you thinking? Well, he's got some really good ideas here. What did 9/11 do? 4 planes, international airlines, several, isn't that essentially what they did? Aren't these somewhat exposed? International airlines, what else? What are you picking up there? You got multiple TSAs, multiple rules, all these kind of things going on. I don't know. $1 billion for that. 500 million pounds for North Sea platforms for terrorism and sabotage. Some terrorist is out there going, I didn't think about platforms. Well, that'd be pretty easy, right? We just have a boat, sails over. I don't know how, I'm sure those platforms are pretty well protected. But they're protected from terrorism sabotage, maybe not protected from hurricanes or to some tsunamis, but specifically for terrorism. Significant coverage for the Sears Tower. What did he just say? He didn't want exposure all in one building. Now, what's the Sears Tower today? It's the Watson Tower or something, isn't it? I forget what it's called. Have y'all been in a Sears Tower, anyone? Did you go out on that?
Yeah, the glass platforms.
Yeah, I couldn't do that.
They're crazy.
Yeah. I was in it once for a banking dinner, and they put us on the top floor. And I was there going, I can't wait till this is over because I hate heights. You can actually feel the building swaying, which I didn't like. I thought it was terrible. Because the Sears Tower is very different than the Twin Towers because it's pretty narrow up on top. Whereas the 10 towers were massive up on top. So, but what happened on 9/11? They emptied the Sears Tower, right? They got everybody out as fast as they could. So I don't know if that makes sense. Well, look at the words he's using. Significant coverage. We have written many other jumbo risk. Let me just look at these. World Cup soccer. The Olympics. Now I went to the Olympics in Athens. Was that 2004? I was not an athlete, but as a spectator. This was 2004, so this is just a few years after 9/11. And there was times I was thinking, if I were gonna get headlines, this is when I do it. We had a time where we were on these subways, we were just in there like this. It was just sardine cans. I don't know how good the security was for Athens, but there were some events that they could have done something, but they insured the 2002 Winter Olympics. So 1 year after 9/11, and they're doing the Olympics. I don't know what kind of event you could do at Olympics. I was shocked at the Athens Olympics, how few people were there. I still remember when the U.S. won the 400 meters. They came first, second, and third place, and there was like 6 people in the stands. There was just nobody there. After the last Greek athlete finished, everything emptied out, and there was like 6 of us. And it was so funny because my friends and I, we all did the wave. It was 4 of us, and we did the wave. But I mean, so he's talking about aggregation. Is it possible the simple fact that he's saying this all in one place creates an aggregation that he hadn't thought of before? That people are thinking, wow, let's hit all these things. So I don't know. That paragraph kind of bothers me, and this first sentence kind of bothers me, but you can decide whether he thinks it's out of place. Here he says his quickness, man, it's so strange. Even after 9/11, his quickness to respond has become a major competitive advantage. Our unsurpassed financial strength, well, that's kind of nice, right? If you're going to take on all these risks. Are in a weakened condition. So essentially he's saying, yeah, we lost a lot, but our competitors lost even more. So, hey, let's go pick up some of their business. I guess that's good. That seems almost the opposite of his sanguine about losing market share. Mm-hmm. He's sanguine to pick up market share. They're in a weekend and would have difficulty surviving a second mega cat. Y'all know what a mega cat is? Mega catastrophe. Yeah. I'm in the habit of using the word cat, and I remember my first time I met Dr. Ibbotson, I used the word cat. He was like, what are you talking about? Cat risk, cat risk. He was like, what is cat risk? He was imagining some cat doing major damage to a house or something. I don't know what he was. And I was like, no, catastrophe risk. Here's my first chance to meet this famous guy and make a fool of myself. You don't even know these terms, retrocessions. We'll talk maybe a little bit about them. So yeah, see what I'm looking for there. Look back at those 6 things that he had a list with. Like, you can throw out the ethical because it doesn't really give you anything on that. But just think about them. Aggregation, history, frequency, severity, all the things he said, and do all these risks make sense? Now, one thing about reinsurers is that their deductibles are massive. So what is his deductible here? $1 billion. So they're providing $578 million in coverage, but $1 billion in loss has to happen before they owe anything. So you can see why he's talking about very, very low frequency events. These are very, very rare events, extreme events. So the other thing to think about in your answer is, could all 4 of these happen at the same, not could they, obviously they could, but could all 4 of those happen at the same time because of something that's related between them. So obviously terrorism. So the only thing I can think of would be terrorists reading this and specifically doing this because they really hate Warren Buffett or for some reason. But is there anything else that could link all of these together? And you may not be able to think of a way, or even 2 of these. Got international airlines and the Olympics. Could those 2 somehow get linked together? Now, my boss went a little wild. Well, okay, you're getting to what my boss was saying. His idea was there would be a pandemic overseas, and somehow that pandemic would be brought over the ocean in a hurricane. And so this hurricane and a pandemic hits the United States. But I'm thinking, I don't think any germ's going to survive a hurricane. That just doesn't make sense. So he was going a little too much out of the box. But that's what we did. Same thing you did, Camille. Just sit there thinking, what could destroy this company? Because at USA, hurricanes probably the biggest thing for USA. Earthquakes probably a close second. USA doesn't have these massive types of risks, so it has to be a lot of people all at once. But hurricanes do that, right? Hurricanes, you can hit a lot of people at once. But that's a very different thing. Our terrorism can't create a hurricane. I don't think. I don't know if detonating a nuclear, that's going to be flood again. A nuclear bomb in the ocean to try to create some tsunami. Again, that's not going to be covered by the insurance industry. All right. Y'all see what I'm looking for there? Page 10 assessment, those first 2 paragraphs. All right. Other related research. So let me just show y'all what kind of things I would do. So I would start with Warren Buffett on float. and try to find something recent. So there's a 2010. YouTube is great. So one thing I always forget just how wonderful YouTube is. Profit on float. So it doesn't have to be an article. It could be, well, there you have right there. It's 1998. So that's even that's kind of interesting. That's pre 2001. But try to find something more recent. What that date is. You can't trust the date that it was posted. A storm is coming, prepare for 2024. There's one right there, but does he talk about it? So it doesn't have to be an article. You can listen to YouTube and put that into your paper. That's perfectly fine as well. So don't forget YouTube. I think YouTube's actually can sometimes be the best because it's almost more recent than some of the articles out there. Here's videos on Warren on float. 2018, that's not too bad. Although it may not have anything to do with this article. You could do terrorism, insured risk, and just see what's going on today on terrorism risk. We talk about cyber risk. So you might use cyber risk as one of those experience versus exposure, and just say, right now, I saw an article on cyber risk that insurance companies are insuring it, but in a very limited way, very cautious way, whatever. You'll see what I'm looking for there. I'm not looking for something massive. Probably a paragraph or two with some quotes is really what you're looking for. It needs to be related, so you can't just start talking about something completely unrelated. So it needs to be related to float, or related to these extreme events, these low frequency, high severity type events. There's the Department of Treasury and their program. Same thing on YouTube. That's a little old, but that's the act that was passed right after 9/11. USA participated in this. So the federal government actually, the issue after 9/11 was realtors needed to build these massive skyscrapers, but they couldn't buy insurance because of 9/11. And so the government had to step in and say, okay, well, we'll insure these things. So have y'all seen these buildings in New York City that are pencil thin? These condos? Would you live in a condo like that on the top floor? Would you? Oh man, if I did, I'd have a parachute in my condo. Those things are scary. I mean, they're like this. Some of them are like 100 stories high, right? And the top floor is just, I don't know, like 1,000 square feet. I mean, it's just scary looking stuff. And they're building a lot of those in New York City, mainly because they don't have enough land space. And so they're building these massively tall buildings. Terrorism risk in 60 seconds. So, right. You could even get really specific. D&O insurance after a major bull market. But find something more recent, right? So that's your real goal. Try to find something in the last 4 or 5 years, right? Don't go back to 1994 or something like that, all right? Now, the critical thinking and the clarity, so just to tell you on the clarity, it's good writing. So have good sentence structure. Don't have run-on sentences. If Bill Gates says it's misspelled and it's misspelled, fix it, all right? Don't give me a bunch of squiggly line articles, papers. Short paragraphs, keep your paragraphs short. Did I show you an example paper before? I think I did, didn't I, or did I?
Yeah.
Let me show you one from my investment class. I may have showed, I probably showed the risk management class there, right? I didn't show y'all. So, yeah, I've seen this before. I like this format. I'll put an example Word document of another class out there just so you can see the format. All right. Some of y'all have already done this, right? So y'all probably sick and tired of seeing it. But so this paper doesn't lend itself well to going on LinkedIn, but I would from now on stop writing college papers and start writing professional papers. I mean, if you're an actuary major, you could definitely put this out on LinkedIn, it would fit. So a good title up on top, an abstract of some kind that says what you're going to do in this paper. Here, what you probably would say is the purpose of this paper was to review what Warren Buffett said after the 9/11 attacks and to talk about what the lessons learned were. You know, it's something that makes sense. You probably wouldn't go more than that. Good use of titles throughout. You can do the fancy first letter if you want to. It looks pretty cool. You notice when 2 columns, I like 2 columns, works really, really well. Absolutely single space. Don't do any more double space papers the rest of your life. Narrow, narrow, narrow margins. Major quotes, separate them, italicize them, center them, just looks a lot more professional. You probably won't have many charts in this paper unless you did some other research on that. This is not a good chart here, but he does have some good charts that he did that were pretty good. The way I think on paragraph length is, I think once you get to about 10 lines, you need to start thinking about cutting to a new paragraph. I can say that as a professor reading several hundred papers every semester. There's nothing wrong in a really long paragraph. Just your eyes just can't take it in. It also looks unprofessional if you put it on LinkedIn. All right. So that looks pretty professional, doesn't it? Looks like something you could put on LinkedIn. The nice thing about LinkedIn is the HR people won't read what you put out there anyway. They're just looking for the optics. So something like this, it looks pretty, you get points just for, you produce something that looks professional. And so you need to get that. I don't know how many of y'all have a portfolio on LinkedIn, but you need to have a portfolio of 4 or 5 papers, probably a PowerPoint presentation of some kind, probably an Excel model of some kind. What you guys did for the competition, you might put that out there, those kind of things. So how many things do y'all have on LinkedIn right now? Did you put your papers from last semester out there?
Not yet.
Yeah, you should. Man, they fit perfectly. So I've had several students doing that. I've had so many students get jobs just because of the papers they did in my classes. So your huge advantage, you may hate writing papers, but your huge advantage is few colleges require papers anymore. I've had some students transfer to UT Austin and they're like, no, we don't write papers here. We just do multiple choice exams. So it's a huge advantage to actually show that you can write a paper. The first question they'll ask is, did you do this as a group project? Because they just assume if you wrote a 5-10 page paper, you must have done it as a group. Say, no, I wrote this paper. It separates you from probably 90% of undergraduate students. So this isn't the greatest unless you're an actual student, but start writing like this, making it look professional like this. I don't know what else. Avoid redundancies, good use of titles. Really what you want to do in the titles is your organization's obvious just by looking at the titles. So what would your titles probably look like? Well, here's a clue. How many of y'all last semester used my rubric? It's the best way to start, right? You might change the order, but at least follow the rubric for the first, and then you're going to move it around, do that. That way you make sure you've got everything covered in there. I wouldn't use it exactly like this. Probably find a little bit better wording than that, but that's certainly a way to do it. It's like on this page 10 of 7, I wouldn't say that. Something like, one thing I will say, if you want people to read your paper, every once in a while, do a title that asks a question. That's incredibly powerful. People always read that paragraph. So you might here have a title, is Warren Buffett following his own rules? And then you start off on page 10 of his annual report. He has some interesting, it gets people, they want to read it. They want to answer for some reason. And they've discovered this on the internet as well. Links that have questions are clicked on more than links that have statements. Don't do it every single time because then they're going to kind of get tired of questions. But every once in a while, it's good to throw a good question in there. So that would work there. You might, on experience and exposure, do these 2 all under one area, but I would have all 5 of these, all 6 of these as a title that goes into it. Over here, you might say float and its cost and put it under one section. And then here you have kind of an introductory section. So if I were writing this, I would probably say, okay, float and its cost, here's definitions. So you're just doing definitions, some quotes from Warren Buffett. And then say, given these definitions, how would an insurance company control the costs of float? And then you start the next section. Number 1, expect a profit over time, something like that. All right. So if a good transition, this becomes your transitional section. You notice there's no point There's no points here, so it's just a transitional section. One thing that makes your paper a little stronger, you know, this isn't Ernest Hemingway. We're not trying to write the next great novel. So if you're going to talk about 6 things, it's really good to say, how does an insurance company control the cost of float? Well, there's 6 areas I want to discuss in this. Just saying that is really helpful for the reader to know you can cover 6 things. It's even pretty powerful to number them in your titles. Number 1, expected profit. Or first, expected profit. Second, whatever. You have a title, it's expected profit, and then you say, the first item I'm going to discuss is expected profit. So be very, very specific on what you're writing. The last thing you want the reader to do is say, okay, where am I now? What am I doing? Where are they going? You want it just blatantly obvious as you go. All right. That's true on the professional side too. You don't want your boss trying to figure out what you're talking about and where you are, what your organization is. Okay. And so that's where the coverage point or the clarity points come in. The critical thinking is that you explain it well, you add some extra good insights, those kind of things is what I'm looking for in the critical thinking. Right. So we are going now. There are in the class notes, this whole thing redundant again. I'm not going to go through the class notes again, but you can look at my organization in the class notes. You might find some things that'll help you out there. But we're not going to leave paper 1 forever. So are y'all ready to go out and do paper 1? And you're going to start on it by tomorrow, right? So you don't forget everything we just done. So work on paper 1, get it done, get a good paper 1 out of the way. All right. Any questions on any of that? I'll put this document out there, but I'm not going to put this one because I've typed too much stuff. So I'll give you the original one. All right. So we'll stop it there.
All right. Anybody get all 6? No. Anybody get 5? I need to get 5. All right. Tracy. Okay. Expect profit. Okay.
Market share.
Okay. Sanguine. Oh, market share. We'll have to add a little more than that, but that's it. Yeah. Able to evaluate, right? Oh, experience. Well, what else? Experience versus exposure. All right. Okay. Ethical clients. What's very good. Wow. All right, Gracie. Huh? Causation. Not sure how I don't know how to put it in the last one that's left. You might have come up with the 7th one. I don't know how to spell sanguine either. I'm sanguine, about not being able to spell sanguine, but
SANGUINE.
SAE.
Yeah, the end. That's it. Yeah.
Oh, I was pretty close. Bill Gates couldn't figure it out. Anybody know the one other one?
Severity versus frequency.
Well, where did that? Well, that's on evaluate. All right. So that's a good point. So on evaluate, you want to make sure you have frequency and severity. So yeah, that goes there. What do we add on expected profit? Remember, over time, not necessarily every year. The key on market share was what? If competitors. Oh boy. Competitors offering rates. I can't spell the word competitors. Same old like compet. Let's see if Bill Gates can do it. Frequency and severity on evaluate. Experience and exposure. You can remember the 2 ways. That's real important, right? Not enough history, or you have history, but the world's changing. Remember, those 2 things are really important. So there's one more left. You got an R in it and you got a C in it.
Correlation.
Correlation is the second part of it. Yeah. This might be something you use to change channels on a TV. Remote loss possibilities, including aggregation of losses. And that's where the correlation comes in. And you can probably quote him on the ceaselessly search for correlations that, I can't remember the rest of his sentence, but I like that ceaselessly search. So, right.
Let's have a question. I wrote down, underwrite what you have data for. Would that?
That's the evaluate. Yeah.
Okay.
Ability to evaluate. So you have data on frequency, data on severity. Yeah. Right. That should be the whole thing. Y'all know the rubric is at the bottom of the page 1 description. So it's in there. Expected profit, be willing to lose market share, be able to evaluate frequency and severity, remote loss possibilities, and then aggregation where you get the unexpected correlations, avoid business with unethical, and then experience versus exposure. All right. So, Gracie, anybody get 4 out of them? How many did you get?
About the same.
About the same? All right. All right. That's good. I'm impressed. Since I didn't tell y'all we're going to do this, that was good. All right. So let's talk about this industry. Let me real quick. Johnny, Luciano, Jonathan, Selma, Leo. All right. I think that's the only 2 people here. All right. Let's talk about this industry. It is an interesting industry. The economics of it. For the P&C side, remember frequency and severity is very important on the P&C side, both of them. On the life insurance side, severity is somewhat of a given. You know how much you're going to pay if someone dies, but on this side, how many accidents are you going to have? And if you have an accident, how much is it going to cost? So you have to know both of them. The multiplication of frequency times severity gives you what's called the expected loss. We call it the pure premium. The pure premium. You may remember what we called it in the life insurance class. It wasn't called pure premium. What did y'all calculate in the second exam? Starts with an N. You remember, Holiday? Net premium. Yeah, on the life side. So the pure premium or the net premium is just the premium that covers only your claims. Doesn't cover expenses or profit. It just covers your claims. All right. So the pure premium. If you have a 22-year-old male driving, I don't know if there's such thing as an 8-cylinder car, but a real powerful sports car, you have a 2% chance that he's going to total the car. The car is worth $50,000. So your expected loss is 2% times $50,000 or $1,000. Now, what's the insurance company going to charge? A lot more than $1,000 because they have expenses, they need profit. And so what that means, and this is really important, I forgot to put the word because in the notes, but what this means is anytime you buy insurance, you're expecting to lose money. It's just the nature of insurance. Because your expected loss is the same as this. This driver expects on average to lose $1,000 a year, but he'll never lose $1,000. He'll either lose 0 or 50,000. But he's probably going to have to pay $1,200, $1,300, maybe even $1,400 for this insurance. Why would you spend $1,400 on something that you expect to cost you $1,000? Well, because you're not going to lose 1,000, you're going to lose either 0 or 50,000, and he just can't manage that losing 50,000. So it all comes down. We'll see a lot of this when we talk the credit scores. All right, so insurance is price. So the policyholder on average is going to lose, and that's because they have to charge more than expected loss. Can you go in knowing you're going to win? You know you're a horrible driver, but the insurance company doesn't. Yeah, I guess that's possible. They're going to figure it out pretty fast, though, aren't they? So, yeah, they'll look at you and say you're a 22-year-old male driver. Okay, you're a pretty bad driver to start with. You say, oh, you don't know how bad I am. Well, they will. They'll figure that out, and then they'll start charging you more. So there is some of your own experience that will impact that. We'll talk about it later. The reason, if you have an accident, they don't charge you more because they're trying to get money back from you. They charge you more because when a 20-year-old driver that doesn't have an accident suddenly has an accident, they now move into another risk group. They're now a 22-year-old that has had an accident. So you're priced in that next pool. And so they're going to charge you whatever they think your probability is. So there are false positives all to play. We're going to talk that with credit scores. Are there people with bad credit scores that are wonderful drivers? Absolutely. and they're the ones that are hurt the most. Are there people that have great credit scores that are horrible drivers? Yeah, they are, but they win in this game. We're going to talk about telematics as a way to maybe get around that issue of the false positives. But insurance companies, they group you into groups. And if you're different in your group, you're either getting overcharged, undercharged. But the average person is getting overcharged because they have to add in expenses and profit. All right. Always remember that, because, and you're going to see why I don't buy parts B and C of auto insurance. If you know it's a losing proposition, do you want to buy as much insurance as you can or as little as you need? What would you think would be the right answer? As little as you need. You know it's a losing proposition. You shouldn't be overbuying stuff that you know you're going to lose money on average, especially if it's not that serious of a loss. It's a very inefficient industry by design. And not to pick on your actuaries, but insurance companies have actuaries, which are a very expensive workforce, very necessary, very important. But also banks don't have actuaries, mutual funds don't have actuaries. You know, that's a very expensive part, and they're a large number. I don't know how many actuaries P&C has, but it's an army of them. I got to meet a bunch of them. Smart people, but they're not cheap. They have others. They have underwriters. We'll talk about underwriting. They have investment professionals, which banks and others have as well. They have other experts. Yeah, I remember UTSA, they had a fire guy. They had some interesting stuff down in their basement. I don't know if they still have this, but in their basement, they had like this fake kitchen. And so a member would call in and say, hey, my kitchen caught on fire. I had the skillet on, but it was only there for like 3 minutes. And you says, I bet not. And they go into their fake kitchen, they turn on the skillet for 3 minutes and there's no fire. And they say, no, it wasn't 3 minutes. You had been away for 30 minutes. And so they test all that. That's a lot of experts that are, you know, they're kind of forensic scientists here saying, did that really happen? You know, so when should you buy insurance? We're going to ask that question. We're going to ask these two questions. The first one's easy. When should individuals buy insurance? There's 3 questions. All right. So this is where we're going next. When should individuals buy insurance? We talked about that in my life insurance class. So you're going to see that again, those that took that class. I won't ask if you remember it, but hopefully you will. The second question, you might say, why is this a different question? But it is a very different question. Why should corporations buy insurance? I think a better question actually is this one. Should corporations buy insurance? That's the actual question we're going to ask. All right. Do corporations buy life insurance in case they die? So why would they buy property and casualty? We'll talk about that. I love this question because you get to bring in the capital asset pricing model one more time into another question. We overkill this. And then the third question we're going to ask is, when can the insurance companies sell insurance? What's the nature of those risks? We've covered that somewhat with Warren Buffett, but we'll do a little bit more extensive list. So we have 3 questions to ask and to answer. The first one is about you as individuals. When, not should you should buy insurance, but when should you buy it? What type of risk? So let's get some categories. So what about things that don't happen very often? And when they happen, they're pretty inexpensive. Would you want to buy insurance on that?
No.
Absolutely no. Why? Because they charge you more than expected loss. You're better off just paying for it yourself. Warranties is a good example. Now, I don't know how many of y'all have the warranty on your phone, smartphone. I don't believe it, but if you have it, you know, you can debate that. I know people who absolutely love it and they live by it. I don't know if they ever stop to think premium versus what they're getting back. Maybe they lose their phone so often. But I don't buy that stuff because I can't do the math while I'm sitting there talking to the person. Towing labor is a good example. Towing labor is usually part of the policy, but it's usually pretty inexpensive. It's not just towing labor, it's towing labor for a covered loss. So unless you're having accidents every 3 months, it's probably, over your lifetime, you're probably going to pay a whole lot more for towing labor than you actually get reimbursed for that. So what's the best thing to do? Just retain loss control. Those that took my life class, I always have to give this example because it kind of is, to me, is the perfect. So I was on the board of a credit union, and one of the gifts was this really small black and white TV. and that's my only TV. So I didn't have a TV. And that one broke. So I said, well, I'll go buy another black and white TV. So I go to, where did I go? Cons. I go to Cons, which I don't know if they're in business anymore. And they had the same size black and white TV, $16. I said, great, that's what I want. So I go up to the front and the guy asked, do you want the warranty? And I can't remember the exact price. It's either $7 or $9. Let's say it was $9. Do you want the warranty for $9? I looked at him and go, $9 for a warranty on a $16 TV? Are you kidding me? And he laughed and yeah, it's kind of crazy, isn't it? Not, but do you want it? Like, of course, why would I told him, I said, if I drop it in the driveway, I'll come back and buy another one and go home. I mean, it's $16. Why do I care? And I think of even further than that. If I had that warranty, I did break the TV 2 years later, I'm never going to find the paperwork for that anyway. So it's not going to work. It's not going to help me anyway. There is some insurance that's that mispriced. You're paying $9 for a $16 risk. That's kind of what I think about B&C insurance on the auto side. You're paying a couple $100 a year. You might say, well, it's only a couple $100. Yeah, but it's not covering much. You're not getting much out of it. So that's why I don't buy it. So, and what we're going to talk about rate online. You may never have heard that term. They don't use it on the life insurance side, but rate online. This is insurance that has a horrible rate online, and you'll see when we do that math. What about stuff that happens all the time and doesn't cost you much? Again, this one is even worse because if it happens all the time, that means there's a lot of claims, which means what? The insurance company is going to spend a lot of money managing this business, which means it's going to be really expensive insurance relative to what you're getting. My example here is dental cleanings. So if dental cleanings are $100 twice a year or $200, and you pay $250 for the insurance, I'd argue you're better off not buying the insurance and just paying for the $200 in dental cleanings. That would be a whole lot better. The problem is with dental insurance is they mix the dental cleanings with the root canals and everything else, so you can't separate them out, unfortunately. I wish they would. You should just be paying for your dental cleanings out of pocket. You're not getting any special deal or any, and you think about the poor dental office. You know, I don't buy dental insurance when I get my teeth cleaned. I just give them like my credit card and I go home. Well, I take my credit card with me, but they charge me. If I have insurance, they need all the paperwork of the insurance, and then I got to file a claim. Then I got to get the claim back, and there's paperwork problems. The check doesn't, all that kind of stuff. There's a lot of extra costs because of the insurance. So if you don't need the insurance, you don't want to use it. It's a very inefficient, expensive process. Healthcare checkups. This was, I won't get into it. We talked about it last semester in my life insurance class, but yeah, you should be paying for healthcare checkups out of your own pocket. You might say, well, I only go once a year, but once a year is pretty high frequency. If you're talking auto accidents, kind of the comparison. Most 20-year-old guys go once every 2 decades. So yeah, maybe that would be low frequency, but it's still not going to cost you much. So here, the best thing is just pay it out of pocket. Don't worry about it. John Stossel, in one of his kind of investigative things, he talked about this, talking about healthcare, saying it was like buying insurance for groceries, which is one of the examples I had used. So he was using my example. I don't know if he copied from me, but yeah, there's no reason to buy insurance for groceries. Just pay it out of pocket, because you involve the insurance company. You got this middle person that raises costs. Well, do y'all remember in healthcare, how much does it raise the cost? Remember the 80% claims ratio? So healthcare, by law, health insurance increases healthcare costs by 25%. That's by law, because they have to pay out 80%. If you take 20 divided by 80, you're increasing your cost 25%. So it's pretty expensive.
Do you have any examples where you think you probably should get your shit?
Yeah, that's maybe our last example. We haven't gotten to it yet. We have 4 options, right? Low frequency, high frequency, low severity, high severity. So what have we gotten to so far? We've done high frequency and high frequency. So things that happen all the time, you don't want to use insurance because it's just a lot of costs. All right. What about high frequency and high severity? That's the disaster of life of somebody. They live on the coast and they have a hurricane every year. That'd be good if you could afford it. But now some people think a house on the coast of Florida or Alabama, you know, think if you got a $4 million house, and you can do the math here, So you got a house. It's a $4 million house. And you know for sure it's going to be destroyed by a hurricane at least once every 50 years. What's your premium going to have to be? Well, you take 4 million divided by that. Just for the insurance company ignoring time value money, you're going to have to charge you $80,000 a year, right? Because you're expecting to have to rebuild this house at least once every 50 years. And it's a $4 million house. How's the insurance company going to rebuild this? They need $4 million. So 4 million divided by 50, who are y'all going to pay? How many of y'all are going to pay $80,000 for homeowners insurance? Probably not going to do it, right? So what should this person do? I would say buy 50 houses in San Antonio and rent them out. And with all the extra money, go stay in a 5-star hotel on the coast and take a private jet there. You know, it's just like, it doesn't make any sense to do that transaction because the insurance, and this is what Florida is going through right now. I don't know if y'all have read the news. Homeowners insurance in Florida not available. I can't. You'll probably find the Florida home insurance crisis, what homeowners need to know. What do you do when you have a $4 million house and no one is selling you insurance? You've got a problem. Realtors have a problem. They can't sell new houses. They can't build new houses. What does the insurance industry say? Hey, we're going to have to rebuild these houses because they're going to have a flood. They're going to have, they're going to have a hurricane. It's going to happen. And if it's and these are expensive houses, you know, right on the coast. It just doesn't make sense. So there made an article like this that might fit in as your extra analysis for paper one, because you probably could make a connection with that and what Warren Buffett is saying. So on this, it's just not going to be affordable. People in California are discovering this with earthquake insurance, not so much in the premium, but with the deductible. They're having deductibles that might be $25,000, $30,000. So you say, well, I got insurance, but if my house gets destroyed, I got to pay the first $30,000 out of my pocket. That doesn't sound good, but that's because the insurance companies say we can't afford this. These are huge, huge risks. So a really sick person trying to buy life or health insurance, they probably waited too late. They should have bought it while they were still healthy. Building a house in a floodplain, a 16-year-old driver, you might say, what's the age in Texas? It's 16 still? Yeah, that's just checking.
15 for a learner's permit.
Oh, really? Yeah, my friends on Facebook, hey, look who's driving now. I'm like, oh man, keep them out of my neighborhood. War, people in war for life insurance, most life insurance companies don't cover war risk. So what should you do? I mean, I would say sell the house and move if you're in that kind of place. Your ultimate is retention. You know, if you're unhealthy and you can't buy life insurance or health insurance, you waited too late to buy the insurance. It's going to be, you know, just too late to do anything. The insurance industry obviously doesn't want to do this because it's both expensive because they have a lot of claims, and the premiums are going to be so high. There's just no way to handle that. All right, so Jalen, to your point, when do you buy insurance? Low frequency. Why? Because it keeps the costs down dramatically. The insurance company doesn't have to do much. High severity. Why? Because even though you pay more than average, it's not a whole lot more than average because the insurance company doesn't have to spend as much more because it's low frequency. So that's when you buy it. So auto insurance, at least part A and part D. Life insurance makes a lot of sense. Life insurance is pretty amazing, right? You pay $20, and if you die tomorrow, your family gets $500,000. That's a pretty amazing little payoff. Homeowners insurance. Now, you may say on homeowners insurance, you might not even think about it because your mortgage bank's going to require you to buy it. But that's not a good way to think about it. They may require you to buy it, but you still have the choice on what you buy, your deductibles, and those kind of things. So we'll talk about rate online again. But yeah, you want to buy insurance for things that happen very infrequently, and when they happen, they really cost you a lot. So let's talk about rate online. I think I put a spreadsheet out there for you for rate online, so I'll show you this. Okay, it's under module 1.
So these are actual numbers, but I haven't updated them in a while, so I don't know if they're still current or not. So this is something you can do yourself. It's a really good exercise to do. So my USAA, I have insurance with USAA, auto insurance. And on their website, they allows me to do experiments with deductibles. So I did 1,000, this is Part D. Y'all know what Part D is? Comp and collision. So any damage to your car, okay, comp and collision. So if a tree falls in your car, if you have an accident, someone runs into your car, even if an uninsured motorist hits you, you're still Part D is covered. All right. What if you have golf clubs in your car and they get stolen? Does Part D cover that? No, that's homeowners insurance. All right. So we got to be because of Part D. So $1,000 deductible, the premium was $290. 500 deductible, premium was $336. $100 deductible, the premium is $476. So way to think about this is how much additional coverage am I getting? So if I go from 1,000 to 500, I'm getting an extra $500 of coverage. What is that costing me? It's costing me $46. So what Rate Online says is how much is the premium as a percentage of the additional coverage? And you want that number as low as possible. All right. Look at the $100. $100, I get an extra $400. Y'all see where I'm getting that? I'm going from $500 deductible to $100. So if I have an accident, I only have to pay $100 instead of $500. So I'm $400 ahead, but it's costing me an extra $440. That's 35. That's a really high rate online, right? It might be worth it to do the $500 deductible. The $1,000's probably not, it's not saving you that much, you know, $46. This was annually, so 40, you're talking, $4 a month, not saving you that much. So 500 might be the sweet spot for your deductible. So Rate Online, not just for this insurance, it's true for homeowners, it's all insurance. So you're trying to decide, well, what level do I get? What is the additional premium you need? All right. This is what you should do for Part B and C. How much more premium? For me, it was a couple $100 for Parts B and C. And what additional coverage? And in my opinion, I was getting zero additional coverage. So what's my rate online? $200 divided by zero is an infinite rate online. In my opinion, I was getting nothing. Some of y'all would disagree and think you're getting something. You have to decide on that. Same thing with homeowners. The nice thing about homeowners is it's not as sensitive. So you can play around a little bit more and get a pretty good rate online by changing it. So I don't think the 100 makes sense. And the reason the insurance company doesn't like the 100 is they get a lot more claims. Going from 100 to 500 kicks a lot of things out that they don't have to deal with. So their costs are much lower, so they can charge much less. Any questions on that? You'll see how to do that math. Yeah, John?
Just checking, you said Rate Online, you want it to be the lowest rate.
Yeah, because you're taking the additional premium divided by the additional coverage. So it's how much does that cost per extra dollar of coverage? So every extra coverage costs you an extra 9 cents. Whereas here, $1 of extra coverage costs you 35 cents.
And you got those numbers like from an insurance.
Yeah, at USAA, they had ability where I could change, they don't update the policy until the very end. So if I change these, I run the numbers, they ask, do you want to update your policy? I just say no, and I go back and run it again. Yeah, insurance company, I use insurance companies' websites. Well, I remember last semester, I was showing someone an immediate annuity, and sure enough, the next day USAA calls me. We want to help you with retirement planning. And we have someone call you. It's like, no, I was using it in my class. So if you do this, you'll probably get a phone call. But you can do this for your deductibles. You can do it for Part A, especially. You'll be amazed how cheap Part A is. Part A is the liability coverage. There you're not changing deductibles, you're changing coverage, how much coverage you have. And people make big mistakes on Part A. You only buy 25,000, whatever the state minimum is. I forget what Texas this is. They buy just a state minimum, whereas they went from 25 to 50. It doesn't cost them that much more, and they'd be much better citizens if they bought more. If you only have 25,000 in coverage and you cause an accident, you may not be able to cover their costs. So Part A is really cheap. I was amazed at how cheap Part A. In fact, what I did when I canceled Part B and C, I put all of that premium in the Part A and an umbrella policy. I bought liability insurance. Now, you guys some of y'all may not care about liability because maybe you say like, hey, sue me, I don't care. You know, I'm a college student, I don't have any assets. That may be true, but I'm retired, so I have my whole portfolio. I don't want to be sued. So I put more on the liability side because that's much important to me. And it's so cheap. You can get a lot of liability coverage for just a few dollars. So, you got to spend your dollar. And this is a different way of thinking of your insurance as a budget that you're going to allocate out versus just doing, y'all can correct me on this, but I bet there's several people in this room that are doing exactly what their parents had set up for them for auto insurance. Is that true for some people? You don't even know, you're just doing whatever has always been done. And guess what your parents are doing? Whatever their parents do, right? It's just this long cycle. My dad used Allstate. Why? Because Allstate sent him a birthday card every year. Right? Is that a good reason to choose your auto insurance company? Allstate's a pretty good company, so it's probably okay. But you should think of it more as a budget. So think here's in fact, the best way to do is take your entire insurance budget and say, okay, I'm spending $1,400. It's going in these places. Could I reallocate that $1,400 and get a better rate online, get more coverage for the same amount of dollars? That's what you're after. All right. Any questions on that? Actuaries think rate online, especially for reinsurance. We'll see that when we talk about reinsurance. They're talking about, remember Warren Buffett talking about $1 billion deductible versus a $1.2 billion deductible. There, your rate online is much bigger. You're talking hundreds of millions of dollars. So, all right. So CXL, we did CXL. All right, so that answers the first question. When should individuals buy insurance for low frequency, high severity events? That's ideal for insurance, and it does make sense. What about corporations? Perfect. So I love this question. Hopefully y'all all remember a capital asset pricing model. I think every finance and actuarial science major should be able to write a 20, 30-page paper on CAPM off the top of their heads when they're about to graduate, because you've seen it every single class. You're sick and tired of seeing CAPM. But here you won't be sick and tired of seeing it, because we're going to look at it in a very, very different way. Who in here could do a 10-page paper on CAPM off the top of your head? Anybody? Takers? No takers? Gracie's already gotten her points, so she doesn't need to do it. No takers? Now, your actuaries are thinking, well, I'm not a finance major, but I had to do CAPM at UTSA, and I was explaining to the P&C actuaries what we were doing, and they knew it as well as I did, so that's no excuse. It's probably on the actual exams, I would bet, because it's important to the pricing. All right, so if no takers, let's refresh our memories. The capital asset pricing model is talking about, it says capital asset, but it really applies to stocks. So it's the return the insurance company needs on its stocks. It's the return on equity. It's not really a pricing model, although actuaries use it for pricing their premiums. But what they're saying is, what return on capital or return on equity does this firm need to cover its loss, its risk? And it's not really a model, it's a formula, but it's a formula we use. Y'all know the formula though, don't you? That looks familiar?
Yeah.
The cost of capital is risk-free rate plus beta times the market risk premium. So the key to here is the beta, because that's the only thing that is specific to the company. So beta is a measure of the relative non-diversifiable risk, or the relative systematic risk of a company's stock behavior relative to the market. The S&P 500 is what we use. A beta of 1 is a stock that has the same level of systematic risk as the average stock in the market. So Google's beta is 1.5. They have 40% more systematic risk. What is systematic risk? Your exposure to the economy, your exposure to interest rates, to inflation, those type of things. You're sensitive to economic shocks. Total risk includes systematic and unsystematic risk. Systematic risk are those industry, economy-wide risk. Unsystematic risk are company-specific risk. All right. Company-specific risk are
easily eliminated. How? By diversification. You can't eliminate systematic risk through diversification. So if you have 20 stocks and you say, hey, I'll go from 20 stocks to 40, that's fine. You can do that, but you don't reduce your systematic risk. You got to reduce your unsystematic risk. How do you reduce your systematic risk? Not by adding 20 more stocks, but by selling your high beta stocks and buying low beta stocks, right? You got to buy the right kind of stocks. All right. So total risk, remember standard deviation measures total risk. Systematic risk are the risks the company has that are exposed to the economy. Unsystematic or company specific. Now, some of y'all have had my classes before. Y'all remember for a typical stock, what percentage of the risk is systematic? What percentage is unsystematic? Can you remember from last semester? So for most companies, the majority is unsystematic, which is pretty amazing. For most companies, 70–80% of the risk is unsystematic, which means for a typical stock, when you buy it and put it into a portfolio that's well diversified, 70–80% of the risk of that stock just completely disappears. That's real important to this question. So on the exam, when you're answering this question, you've got to talk about systematic and unsystematic. A lot of students just leave it completely out. And you got to understand what it has with this problem. You don't know yet because I haven't told you, but it's going to be very important. All right. So Google fires its CEO and hires a new one. Is that systematic or unsystematic? Unsystematic. Google creates a whole new AI software package that beats ChatGPT out. Is that systematic or unsystematic? Unsystematic. Okay. Let's see. It's hard for me to come up with systematic that aren't so obvious, but yeah, I mean, we go into recession and Google loses 20% of their customers. Obviously, that's systematic. All right. So the key is unsystematic is easy to get rid of, inexpensively. It just disappears. All right. Inflation, interest rates, anything along this line. So beta it's a number you can look up, but looking it up doesn't really do anything for you because it's such a an unstable number. I just said Google's or Alphabet's is 1.4. I have no idea what it is recently. 1.05. That's way too low for a Google or Alphabet. But you notice it says 5-year monthly. That just means that's their beta if you use the last 5 years monthly data. But it's all over the place, right? It could be 2.1, it could be whatever. And probably in 2000 or 2001, it was 1 or 2.5 because tech stocks all sold off. So you can look it up on Yahoo Finance. So that's not really their beta. That's their historical beta. Beta, from our standpoint, is a futuristic thing. What is their true exposure? My job at UTSA was to come up with UTSA's beta, but UTSA doesn't have stock. It's a private company. And so what I did is I went out and looked at UTSA's competitors and saw what their beta was, and then I adjusted it to get one for UTSA. Why? Because that's what the regulators are going to let UTSA make when it prices its auto and homeowners insurance. What return on capital will UTSA get? We use the capital asset pricing model. Why did I use that? Because regulators had no choice but to accept it. It's well accepted, well known, and so they took it. They did question some of my assumptions, but no difficult questions. Betas are terribly unstable, so it's kind of harms the theory, but that's historical betas. I don't care about that. It's the future. What's your view? It can be a very subjective opinion that you think this company's exposure is to those systematic things. So unsystematic risk is firm specific, idiosyncratic. It's very easily to eliminate. You can do it in one phone call. You can call Vanguard and buy their US stock mutual fund, and you've eliminated all of your unsystematic risk. And so what the theory says, and this is real critical to where we're going, the theory says there's no compensation to the investor for taking unsystematic risk. Why? If they put all their money in one stock, they're not going to get a very good risk return on that because they're taking massive risk having all their money in one stock. But the market says, hey, that's your fault. You should have put it in a diversified portfolio. You could have eliminated 80% of that risk. Your choice, put all your money in one stock that's your dangerous thing to do. So So unsystematic risk is easily eliminated, so the market does not compensate you for taking this. I'm not going to go into the formulas, but it's the formula for beta is a pretty simple formula. It's very similar to correlation. For beta, it's covariance divided by the standard deviation of the market squared. For correlation, it's covariance divided by the standard deviation of the market times the standard deviation of the stock. So you notice with correlation, you have both the stock and the market. But for beta, you only have the market because it's systematic risk. It's also the slope function in Excel. So we don't need that for this class, but just to remind you. All right, so that's the refresher on CAPM. Is it coming back to you? You have some knowledge of CAPM. It's extremely important theory. I will say on the CFA exam part 1, I thought it did pretty well in the morning session. It was all essays. The afternoon session was all multiple choice. So I go in going, I think I'm pretty good. And then the afternoon session, I left going, I know I passed this exam because they kept asking CAPM after CAPM. All I do is plug 3 numbers into a formula over and over again. Probably 15% of the afternoon exam was plug 3 numbers into the CAPM formula. It's like, I can do that all day. So it's an important concept. All right, so I don't know if any of y'all want to guess what this has to do with insurance. I don't think you would, because this is pretty bizarre. It's a really fun execution. Note takers. So you might ask the question, what kind of risk does a typical insurance policy cover? So a company buys insurance. So let's say Home Depot buys insurance from Hartford. Are they buying insurance to cover Home Depot's systematic risk or to cover Home Depot's unsystematic risk? Unsystematic risk, right? A building burning down, that'd be unsystematic. Hurricane, you know, some of it may not be. We'll talk about that. Directors and officers is a good example. Workers' comp is a good example. But for the most part, most companies are, when they buy insurance, they're buying it to cover unsystematic risk. So D&O, terrorism, maybe there's some that are related to markets. We're going to ignore those right now. What do we say about unsystematic risk? The market's already eliminated. And how much did it cost us to eliminate them? Almost nothing. All right, so here's the question. How much should management spend to eliminate a risk the stockholders are already eliminated for free? Zero. That would be the theory. So go back to the question. Should corporations buy insurance? What does CAPM say? The theory says no. Why would you spend money on something that's already been taken care of for free? All right. So most stocks are covering unsystematic risk. There are a few exceptions. And I gotta say, even with these exceptions, it still doesn't make sense. But for the unsystematic risk, it doesn't make sense. All right, so I can't remember if I put this out there. Yeah, I'm gonna show you all this. All right, so this is the part students do the worst on exam 1. So this might be something I'm gonna come back to right before the exam, just to make sure you're understanding where I'm going here. I'm gonna use the term expense leakage. Number 1, you can't use that anywhere else because it's my term. All right. If you go on an interview and talk about expense leakage, they have no clue what you're talking about. But number 2, you got to explain it. You can't just write expense leakage on the exam and get full credits. So let's say this is Home Depot. And let's say this is Hartford. And let's say you have these 2 stocks in your portfolio. Okay. So do you want Home Depot to buy insurance? So let's look at it. Let's say Home Depot has $1 billion in revenue. Hartford has $500 million. Home Depot has $800 million in expenses. Hartford 400. So Home Depot makes $200 million. Hartford makes 100. So in your portfolio, these 2 stocks add $300 million in earnings to your portfolio. But let's say Home Depot has a loss. We'll get into this. Let's come down here. All right, let's do this example. I'll come back to it. So what if Home Depot buys 50 of insurance? Their net income goes down 50, right? Everybody, you're ignoring taxes, right? See that? They made 200 before, but now they pay $50 for insurance, so now they only make 150. What happens to Hartford? Their revenues go up 50. But what else happens? What do you notice with their expenses? Their expenses go up 20. Why do their expenses go up 20? They have to manage this business for Home Depot. They have to have adjusters, they have to have claims reps, they have to have underwriters, all this. So they don't get to keep the entire 50 because a portion of that's going to go to their expenses. So how does your portfolio do if there's no loss? If they didn't buy insurance, your portfolio would have made 300. But because they bought the insurance, what is your portfolio making now? 280. Why is that? Because Hartford has expenses. Now, is it possible Home Depot has some expenses? It's possible they have an insurance person that they hired to handle this, and there's a little expense. These numbers are not necessarily to scale, but I'm just giving you the case. So you as an investor, how did you do? If there's no losses, no insured losses, how did your portfolio do because they bought insurance? They did nothing but take your portfolio money and spend 20 on the employees at Hartford. Is that what you want your portfolio to do? Or you're trying to full employment at Hartford? Is that your goal of your stock portfolio, or would you rather just keep that money? All right, so what if there's a loss? How does that change things? So let's say I don't remember why I did that. I must be adding up numbers in below. Let's say there's a warehouse fire for $500. All right. So they made 1,000 in revenues, expenses of 80. They got 50 of insurance. Their warehouse burned down, but they got an insurance claim. Well, that's good. So they made 150. That didn't hurt them at all. You're thinking, wow, that's great. I did great. I'm glad they did that. Hartford has an extra 50, right? They started with 50. They had started with 500, but they got an extra 50. What do you notice about their expenses? Went up a bunch, didn't they? Why? Because they don't just have underwriters and policy service. They also now have adjusters, and they got to pay $500 for the warehouse. What happened on the loss side to your portfolio? Just left pocket, right pocket, right? One of your stocks in your portfolio lost 500 million, so another stock in your portfolio paid them 500 million. Your portfolio doesn't care. How can you come ahead in this transaction? There's just no way to do it. So your loss is, your loss is going to be, you're going to be worse off by 50, and that's that expense leakage. You might say, well, they had a $500 million loss. You would have lost that 500 either way. Whether they bought the insurance or not, you would have lost the 500. The 50 doesn't matter to you because the 50 is an expense for one and revenue for the other. The loss doesn't matter because that's left pocket, right pocket. The premium doesn't matter because that's left pocket, right pocket. So the only thing that matters are the expenses of running this business. And we know this is an expensive business. And so anytime corporations buy insurance for unsystematic risk or even systematic, it's a wash in your portfolio. There's no way to get around that because of the expenses Hartford has incurred.
So the only way sorry.
No, go ahead.
The only time you do it is if it was going to make Home Depot go bankrupt and the bankruptcy costs are higher.
Yeah, you could certainly get there if that loss would, but then you're getting to kind of it kind of depends because if you have, even then it's a little tough because if you have lows in your portfolio, they may shoot up. Who knows? I mean, it's hard to say exactly. But yeah, if they go bankrupt, yeah, you're losing a lot of value there. From a societal standpoint, that's where we're going to get to, which is the argument for this. This is the stockholder argument. From a societal argument, Home Depot going out of business is not good, so we'd rather than buy the insurance. So we're going to talk about the other stakeholders. But y'all understand expense leakage here, though. It's the cost of the insurance company to manage this business. Everything else is the left pocket, right pocket. The premium, the losses, all that's just left pocket, right pocket. Now, I've had students say, well, what if I just buy Home Depot and don't buy Hartford? I don't know anyone that's going to say, I'm just not going to buy insurance companies to avoid this. That's just a bizarre way to manage a portfolio. So
Hartford is it a company like Home Depot or is it a?
Hartford is an insurance company. I was hoping y'all had heard of Hartford.
Okay.
So y'all, I kind of, what insurance? Y'all know Allstate and State Farm, right? Hartford's kind of only mainly a commercial insurer. So have y'all heard of Chubb? Oh, man, okay. All right, so Hartford is an insurance company, Chubb is an insurance company. There are insurance companies that really do commercial, so you don't see them as much. Hartford does do some auto. I saw some Hartford TV commercials a little bit, but maybe not. You probably don't see Chubb because Chubb is almost exclusively commercial. So unless you got a big business, you're not going to do that. Like kind of like AIG, you don't do much with AIG. It's more of a commercial writer. So yeah, we're talking about a non-insurance company and an insurance company in your portfolio.
In your portfolio, you mean in,
Your personal stock portfolio,
so that means I own stock in Home Depot and in this
and maybe
insurance company.
400 other companies as
No, I'm
well.
just saying, so for this example,
Yeah.
you're saying that, okay. That's the revenue. And then, so the expenses, you kind of just made those numbers up, the 420.
Yeah.
Okay. Oh, because the first one is you have no.
Yeah, Hartford doesn't have any business with Home Depot, so their 400 is for all their other business. But as soon as Home Depot comes, they're going to have someone assigned to that policy. They're going to have policy reps. They're going to have underwriters. There's going to be a cost. The 20 is a little exaggerated just to make the numbers work, but yeah, I mean, that's what's going on. So the key on the exam is that you explain what I mean by expense leakage. That your portfolio is a wash. The premium and the loss are a wash. It's left pocket, right pocket. What's not a wash is the fact that they're paying their employees to manage this business. A risk you've already eliminated by diversifying your portfolio. It's already gone. And yet now you're spending 50 to pay those employees. It's probably the hardest part of exam one's essay. That's probably the toughest one to talk about.
Yeah, we spent 2 minutes.
So, and that's true even with the risks that are systematic. Because even if they're systematic, you still got that left pocket, right pocket issue. You still have the expense leakage. So even on directors and officers insurance, yeah, it's systematic. But if it's systematic, it hurts Home Depot in a recession. So they just shifted over to Hartford, gets hurt in a recession. It's the same kind of thing. You're kind of hurting them one or the other. So, so if we can, I had a really great sentence in here. Yeah, I love this last sentence. I said it in class and said, wow, what did I just say? That sounded really good. So I try to write it. It probably won't sound so great now. It never sounds as good the next day. You don't want management spending precious corporate resources to mitigate a risk you, the investor, already mitigated via simple diversification. It's actually a pretty decent sentence. It doesn't have the alliterative that Warren Buffett had on the ceaselessly search, but now this last sentence is really critical for your essay. So everybody make sure you're paying attention here because students leave some big points here. You got to make sure you know whom you're talking about. Management is the ones who buy the insurance. We're talking this from the standpoint of the investor. So on the exam, don't say it doesn't make sense for you to buy insurance because you've already eliminated the risk. Who is you? Who's buying the insurance? Management. Who's already eliminated the risk? The investor. All right. Be real clear on who is who in here. So it doesn't make sense for that's why I have them highlighted. It doesn't make sense for management to spend these resources since you, the investor, have already eliminated that risk through diversification. All right.
Are you saying that it's eliminated because?
Well, let's say Home Depot has the fire in their building. Someone else is going to have some big windfall happen. You have 500 stocks in your portfolio. Yeah, Home Depot loses 500, but NVIDIA just invented a new software package and they made 500. That's what unsystematic risk is. It's all this stuff all over the place. Some people get good news, some people get bad news. You don't know what these are. It's pretty random. So just because Home Depot had a big fire, maybe Lowe's just announced a new marketing campaign and they picked up 500 million. And your portfolio is a wash. Those things are happening all over the place. And that's part of unsystematic. They're uncorrelated. They're just random stuff all over the place.
Right.
So unlike systematic risk, everybody's getting crushed at the same time. There's a recession or something like that.
I'm trying to understand your expense leakage and I'm trying to figure out.
Well, the key is to start with the left pocket, right pocket. So your portfolio can't come out ahead by them paying a premium and then getting a loss because the premium is an expense for one and a revenue for the other. And the loss is an expense when they pay the claim, it's a benefit to one, but a cost to the other. Those two wash. What's not a wash is the fact that they're having to hire people to manage this business for Home Depot. Uh-huh.
And then, I'm just gonna ask, what is a left pocket and a right pocket, and also what is the watch?
Yeah, I don't, I have this problem. I'll use sayings that in my childhood we used, I used to saying once of a poster child in my class was like, what's a poster child? You don't know what a poster child is? So, so left pocket, right pocket means, you take $5 out of your pocket to pay yourself $5. You say, look, I just made $5. And then the next day you take $10 out of your left pocket, put it in your right pocket. Hey, I just made another $10. How much richer are you?
No.
Not too much better off, right?
Okay, would this still be on average? Because like, for example, what if like NVIDIA had some project they're working on and then you did that cash flow that they were now paying for that burn, like, okay, say a factory burned down or something. They now have to pay for that, and that money that they could have put into research to make their company like have a new product, that's also lost. So it's
Yeah,
potentially
the
less as
concept of unsystematic is stuff like that's going all over the place.
but
So you're talking about a bad news, but yeah, that bad news could be even bigger bad news, but someone else's good news. Exxon could have just discovered a new field, and then they drill and discover it's massive field.
yeah, so what if right before that they had a giant problem that insurance would have covered, but since they didn't, insurance wasn't gonna do anything with that money, but Exxon would have with they like.
Well, yeah, but that's it's really systematic is just this completely random thing. Yeah, it's if you're getting to a point where it's so massive, you're kind of jumping into the systematic risk area. In that case, though, still, I mean, just think about it. Let's say it's a massive, massive risk and they're not going to do it. Hartford's still going to lose all that money. So what if Hartford, by paying that claim, they'd lose out on a massive new discovery?
But an insurance discovery, like what would that?
Oh, yeah, a new product they developed that's going to do really, really well. But now because they're having to pay this massive NVIDIA claim, yeah, if you buy into the theory of capital asset pricing model, most people think pretty negative on the stuff that can happen, but I mean, there's massively positive. You think about NVIDIA going up around 100%, like almost overnight. There's a lot of positives as well. I think you're getting to the offset of this is that companies do buy insurance. And I think you're getting more to the societal impact of insurance, because I think CAPM is going to say everything you're saying. There's so many things going on. Yeah, it's possible there's a skew slightly to the negative, but if that's the case, it's a little more systematic, So CAPM really says there's stuff going on all over the place. There's thousands of companies. There's a lot of good news, a lot of bad news. If they're correlated, then it kind of it's not unsystematic anymore. So if it's so much that there's the net negative is pretty material, then you're kind of getting out of the unsystematic category.
I promise one last question. Can you go back to your Excel, please? So when you say portfolio, so I went and I was trying to look up this company.
Oh, I didn't spell it correctly. Sorry.
Right.
Hartford.
So then this is a public traded company. That means that I'm buying shares of this company. Is that what you're saying?
Yeah, you got Home Depot, a public company in your portfolio. You have Hartford, a public company in your portfolio.
Okay, okay. So people invest in stuff.
Yeah, and CAPM's going to say even if Hartford was a private company, it still works because management's still spending the 50 for a risk the stockholders already eliminated. Because when this 500 loss happens at Home Depot, CAPM's going to say, yeah, but there's going to be 500 gains somewhere else from somebody else.
I was
Someone
trying to understand
did
that
something else.
these private companies, we just regular people wouldn't be able to purchase.
Yeah, it has to be this for the scenario. The work has to be a public company.
Right. Okay.
So this is for all risks, whether it's systematic or unsystematic. Having insurance cover that doesn't make sense because of the insurance and this expense leakage. For unsystematic risk, even ignoring the scenario, this CAPM says it doesn't make sense because you're paying 50 for something you've already eliminated. There's no reason to spend the 50 at all. Yeah, it's an interesting concept. The first time I read it, it says, yeah, so CAPM says companies shouldn't buy insurance, but they do buy insurance. So in the exam, I'm going to ask you to give a few examples, 2 or 3 examples. I can't remember what, but kind of to Alex's point, there's other stakeholders here besides just stockholders.
And insurance is a powerful force that allows capitalism to work and work well. So there is, now maybe to your point, there is a definite indirect benefit to stockholders of insurance. So you think about China. In China, I don't know what it is today, but for the last 20 years, China's savings rate was like 25%. It put the US savings rate to shame. It's not because Chinese people are really good at saving, it's because they didn't have a good healthcare system. So if someone got hurt in their family, they were gonna have to pay for a broken leg or whatever. They had to have all these savings there. What insurance does is it frees up all that savings so they can invest in houses and portfolios and cars. So insurance allows economies to work because management doesn't have to be so careful on these unsystematic risks. They can go out and do other things, and the insurance company handles that. So who are these other stakeholders? So lenders, banks, bondholders, they don't benefit from CAPM. You know, CAPM says, hey, if there's bad news here, there's good news over here. Bondholders say, if there's bad news, we lose money. If there's good news, we don't get anything. We got a bond, we make 6%. We don't get the upside, we only get the downsides. So they're skewed to the left. So they can eliminate it through diversification. So they are worried. Employees, they don't want Home Depot go out of business. They're going to lose their jobs. They're going to want their company to have proper insurance so that they don't have to worry about the company going under. Senior management, this is that traditional agency problem. Obviously, the CEO of Home Depot doesn't want them to go under because they're making, you know, a 7-8 digit salary. So they don't have a diversified exposure to Home Depot. They're extremely exposed to Home Depot. It's a big part of their portfolio. So they do want to cover those risks. So what a lot of boards do is they try to get management to hold large amounts of the company's stock so they'll make decisions in the best interest of the company. But here's one case where, according to theory, they're actually making a worse decision because they have so much exposure to Home Depot. They are going to spend money against these unsystematic risks because you've given them so much exposure. And then vendors, USAA, I thought it was ridiculous, but if I signed a contract with a vendor, USAA required me to put language into that contract that if their employee drove on USAA property, they had to have a certain type of insurance. They had to be a certain amount. It's like, they're not going to sign that. So they have to. First of all, they're not going to drive on our property. You're going to be in an Uber. And I don't have a contract with Uber. So I don't know what happens if the Uber guy has a wreck. It's just ridiculous. I mean, I got to go to this company and get them to approve this massive addition of paragraphs that you're going to buy this type of insurance. We got to approve the insurance. And the thing I thought was the craziest is their insurance had to name USAA as I forget what they said, potential beneficiary or something like that. It's crazy to think that. But that was a vendor just going overboard, saying your company can't even drive on our property unless you have the insurance we say you have to have. Just crazy. Regulators, they don't really care about companies doing well. They're just worried about companies going insolvent under their watch. So they're tend to say buy the insurance, and they may require it. So, you know, I'm going to add, Alec, to your point, I'm going to add this one to my list. All right.
Yeah.
I'm going to put society because I think that is a good point. I kind of hint at it, but I don't specifically say it. So society doesn't want good firms going under because they add all these benefits. There have been some really great companies gone under, not so much because of an insured loss, but because of some mistake they made growing too fast or something like that, and we really lost out on them. I'm of the opinion, you know, I hope Amazon goes out of business. I hope Google goes out of business. I hope Facebook goes out of business because they're replaced by someone much better. I'm the kind of person who's like, bring on the better firm. I love that. But the next player is really good, but they go out of business because of some stupid insured loss that they didn't buy insurance for. Then yeah, that's to my detriment. I want firms going out of business. I want Walmart to go out of business. I want HEB. I know that's a sacred company, but I hope HEB goes out of business because someone new comes in and one of you starts a business and puts them out of business. And so yeah, from a societal standpoint, we need that. We talked about, you know, I think I'll talk about it later in the notes here. Is insurance allows free markets to run more
efficiently. So we'll get into that a little later, but yeah, I do think that's an important one. Now, I will say for your homeowners, when you borrow money and your mortgage company requires you to buy homeowners, studies have shown that that's not really that efficient. That banks would be better off charging an extra 1 or 2 basis points on the loan and not requiring homeowners, and that 1 or 2 extra basis points would more than cover their exposure for loss. So that's actually a fairly inefficient thing to require, but they require it just because they've always done it. All right, a few others is insurance companies do more than just pay claims. They're actually pretty good at what they do. They can walk in, we'll talk about this when we talk about boiler and machine insurance. They can walk into a company and say, you know, you really need to fix that. That's really dangerous. And it's actually beneficial to you as a stockholder. They can spend an extra $20 and they eliminate, you know, $1,000 in costs. You are better off. You know, if you would not have this slippery floor here and have put some rugs down, you wouldn't have so many employees getting injured. Say, well, a rug costs $10. Yeah, spend the $10 and you'll reduce your cost. So insurance companies are very, very good at that. It's called loss control. They come in and they say, here's some things you can do to make your business much, much better. Claims administration, essentially, this is the outsourcing part of insurance. So USAA, I worked in risk management for 1 week at USAA. I took a job in risk management, and then my old boss wanted to go back to his job, and they wouldn't let him do it unless I went back to his department. So they gave me his job without his title. Isn't that great? He was senior vice president. I came back as an analyst and took his job. But for the 1 week I was working there, and it was really interesting to me on workers' comp that we had the insurance company involved in everything we were doing. And essentially, we didn't have a staff of 50, but they had a staff of 50. And so they could handle all of our stuff, take care of the paperwork. They would call Mary and say, how are you doing, Mary? How's your carpal tunnel doing? You willing to get back in work? They could do all that for us, and they were really good at it. So it's an outsourcing. So you can see from that standpoint, there is a benefit to the stockholder too, that it's probably cheaper for the insurance company to do it than the company to do it itself. Insurance for small companies. I started my own consulting business. We had to spend thousands on insurance, mainly because we couldn't get clients if we didn't have that insurance. You're kind of stuck. So the insurance company offers insurance. They're also saying this is a legitimate business. You know, you can do business with them. So for small new companies. And then taxes. I'll probably do taxes next class, but insurance is a very favorably taxed product. And so it's kind of, well, maybe I can do it real quickly. We may have to come back and redo it. But the advantage here, if you look here, once Hartford has that $500 million loss, in a year when they only have 100 million in earnings, they don't get the tax benefit of that 500. They have to spread it out to future years. Whereas Hartford, they get to actually spread out those losses over many, many years. So there's an advantage. Hartford can somehow use a tax code to get those losses earlier on taxes versus Home Depot can only get the tax benefit when they have the massive loss. All right. So it's a little hard to explain. It's a little bit of a timing issue. But insurance companies get to set up reserves, which means they get the tax deduction even before they pay the claim, even before they know of the claim. There's something called incurred but not reported. They get to set up reserves even though they haven't had a loss reported to them. So they get to take that tax deduction much, much, much earlier. The company only gets the tax deduction when the loss happens. And then the last one, regulatory utilities. When they buy insurance, that becomes part of their cost base. They get to charge cost plus a premium. So if they pay more in cost, that just increases their revenue. So you as a stockholder, you do benefit from that because they get to charge their customers more. So essentially their insurance cost gets passed on to their customers, not to your portfolio. All right. So I can't remember on the exam how many of these you pick, but pick some of them. All right. That's one to kind of let it sink in. It's a little bit of a tough. It is an essay on the first exam, just hint. So all right, we'll stop there. We'll start here next time. One last question to do. All right, questions on anything? Anybody finished their paper 1 yet? Getting close. So all right, so a couple of you already said I want to meet with you, talk where I am. I'm more than willing to do that.